He built an agency, stepped out of day-to-day operations, and now he's building a holding company with the goal of hitting 9 figures.
Identify a successor within Barrel. One of our longtime employees, Lucas, took over as CEO, and Seuk and I were able to remove ourselves from the business. Yeah, since then, we've been just focused on building this holding company.
Today's guest is Peter Kang, founder of agency holding company Barrel. He's also the author of HoldCo, the practical guide for entrepreneurs to structure and scale a holding company.
Towards the end of last year, I published the HoldCo guide. There's no kind of like easy, accessible book that kind of described this multi-business HoldCo setup.
In today's episode, we unpack how Peter transitioned from founder-operator to holding company builder.
So, hey, you can be an owner in the business without having to work in it day to day and still make money. That was, I think, the birth of really this idea of like, hey, maybe we can own multiple businesses.
What the structure of a truly healthy agency looks like, from margins to management layers.
We look at gross profit / gross margin, and we like to see that healthy is like north of 50%, and like really good is plus 70%, and you start getting some really great leverage numbers. That should leave you with about 25% net.
How he sources, analyzes, and structures acquisition deals.
We have to be disciplined buyers. We want to make sure we get a good return, and there's a margin of safety that can pay down debt we have on the business.
And why stepping out of day-to-day operations is the real unlock for long-term scale.
There's an ego element to it too, like it just won't be done right if I'm not the one to have to oversee it.
So if you want to understand how to turn agencies into assets and build a portfolio that compounds towards that 9-figure target, this is the episode for you. Peter, thank you so much for joining me. Welcome to the podcast.
Yeah, thanks for having me, Jordan.
I want to start on the topic of books. So first off, that is a very impressive bookshelf that you've got behind you. What's the story behind writing your own book? Like, why did you decide to do that?
Yeah, so let's see. So last year I published, towards the end of last year, I published the HoldCo guide. And the book kind of came about organically, maybe a little bit by accident, because I hadn't, started with a published book in mind. Actually, I was putting together a little guide for some friends because, obviously with Barrel Holdings, we were doing a lot to design this kind of structure for, buying and growing agencies. And so, throughout the many decisions, every month of like thinking about, okay, how should, the money flow from the companies? What should we do with the extra cash? Or, how should we, how do we think about performance of our investments? Things like that. I just, start to take those notes down and was sharing it online. And, a lot of other folks who are interested in kind of pursuing a multi-business path, like building a portfolio, would reach out to me and be like, hey, can you share more about what you're doing? And also, can you point me towards some resources so I could do some reading about HoldCos in general? And, to that second question, I was like, they're actually, like, I was making up a lot of stuff as I went. Obviously there were a lot of other, information about other companies that I was reading about that influenced some of the decisions I was making. But I think from, but these were like big companies that, through decades had built a lot of different infrastructure and kind of figured it out. But there's no kind of like easy, accessible book that kind of described this multi-business HoldCo setup. So I was like, hey, why don't I just start writing something? I thought it'd be an ebook that I could just post online or something. But, it got to about like 20,000, 25,000 words. And I was like, yeah, I could probably turn this into a book. So decided to self-publish. And that's how I got to I got to actually publishing it.
Very cool. And I must say, it's very good. I feel like there is a real gap in the space, right? You either have the, super dense M&A 500-page textbooks, but there's not really anything for kind of, obviously the agency space, but also like smaller holdcos that aren't, one of these huge behemoths. So it's very good. Available on Amazon.
Yeah. Yep. I'm available on Amazon, working on the audiobook right now for those who are interested in consuming it in that format.
Okay. Very cool. Well, look, I now want to dive into kind of you and your story. So I follow you obviously online. I'm subscribed to your newsletter. I check out the blog posts that you do as well. You have a very interesting backstory. So born in Korea, worked at Lehman Brothers in investment banking, and then kind of built your own agency and now at the kind of HoldCo level. Can you just walk through that journey and kind of how you ended up where you are today?
Yeah, sure. Yeah, so my family immigrated from South Korea when I was 6. Grew up for the most part in New Jersey, and yeah, just like got into technology pretty early. So this was like the 90s where internet was coming on the scene, and got really into building websites. I mean, the energy is very similar to kind of the AI stuff happening now. I mean, I think back then it was all about the internet. So kind of rode that wave a bit. Went to Columbia University in New York City, and then shortly that's where I met my co-founder. And then once I graduated, I did a stint at Lehman Brothers, but all throughout I was still kind of hanging out with my co-founder on weekends. And one thing that kept us going was like this idea of like building our own business. And a lot of that took the shape of doing website builds and design stuff, like branding for small businesses, nonprofits, whoever would let us take them on as a client. And so yeah, it was just so interesting because I'd work like 60, 70, sometimes even like 80-hour work weeks in banking, and then still meet up with my co-founder Sewuk in my Manhattan apartment, and we just crank out websites, and it was just a lot of fun. And I knew like I would stick it through for till the end of the year to get my bonus, because I thought, okay, that would give me some buffer to at least pursue this thing. And then so I remember once the money hit the bank account, I was ready. I put in my notice, and then was able to then incorporate Barrel, which was our first agency. And yeah, from then on, we just kind of struggle busted for the next 5 years, like basically glorified freelancers, taking on whatever job we could. And then, but we learned a lot. Like we're just so super scrappy, super lean. Just barely made enough to pay rent and maybe some groceries. And then, but we we just met a lot of people, did a lot of projects, sometimes for free. And then little by little, just like built up a reputation, got, you know, kind of upgraded the client roster bit by bit each year. And then, I think, 5, 6, 7 years in, we start to kind of hit our stride, start to, land some more legit clients, and then start to grow our team and, start hiring real people in New York City. And yeah, about 15 years into it, we realized, hey, like, you know, we work with so many different clients. We've done a lot of different work. We had built we did tons of content management system builds on websites, and a lot of them on WordPress. But just I think over the, you know, there was a point at which we started doing more e-commerce, and we really liked the work there. We thought that was kind of where a lot of the opportunities were going to be. So we decided to really hone in on the Shopify ecosystem, and go all in into that e-commerce space. So that meant shedding some of our clients that were no longer fit that kind of mold. But once we kind of did the math, we realized, hey, this maybe deserves its own entity that can service these legacy clients. And I'm sure there's opportunities to get more of these clients. And it was very much like web support and maintenance type of work, especially on WordPress. So we spun that out. One of our employees took the job of leading that company, and with an ownership stake. And that was like the first time where kind of opened our eyes to, hey, you can be an owner in the business without having to work in it day to day and still make money. And so that was, I think, the birth of really this idea of like, hey, maybe we can own multiple businesses. And so, the next one we did was a Webflow agency that we started from the ground up. We hired a CEO from day one to co-found it with us, and that became BX Studio, which is another agency in our portfolio. And once we had 3 going, Sewuk and I realized, hey, like maybe we should be working on this portfolio of businesses full time versus trying to, we were still running Barrel at the time, trying to land Shopify deals, as a full time job. And so, we, identified a successor within Barrel. One of our longtime employees, Lucas, took over as CEO, and Sewuk and I were able to remove ourselves from the business. And so that was about 2 years ago. And since then we've been just focused on building this holding company.
Okay. There's a lot to dig into there, but I want to start with stepping away from the kind of main co into the HoldCo. How was that process, and did you get pulled back in at all?
No, luckily, I mean, we took our time with it because, like, at that point, we had been in that particular business for 18 years, and so much stuff is like wrapped up. You don't realize like how much stuff you just kind of do on autopilot that it's relying on you. So we had to kind of map that. I mean, we did spend like about a good 18 to 24 months with Lucas because, like, I remember having that convo. I'm like, hey, like in basically, by this date, which was like less than 2 years, like I want, I want to make sure you become CEO. And so let's really map out all the things that need to happen. And so, little by little, like I guess the biggest lift was like a lot of the BD functions of like, generating leads, closing deals, and, just all that stuff had just kind of lived a lot in my head, in Sayuk's head. So it's kind of like getting Lucas more involved in that process. And then also, just, having him own certain pieces of it as well. And over time, he started to get more comfortable and, started, getting really good at some of these aspects. And so that helped a lot. And then, the finance part, there was a lot of like messiness associated with that. When you own your own business for that long, you just kind of run some stuff, through the books that you got to clean up, and then you got to kind of really, really professionalize that aspect of the business. And so, took some time to do that, and then also getting Lucas comfortable looking at the P&L and understanding, balance sheet and stuff like that. So that was also the other one. And then the other stuff is just, more about like just team meetings and other aspects of like interactions with the team, just making sure that bit by bit Lucas, it was almost like it was really gradual. So by the time like we did the handoff, like everyone, like it wasn't a big surprise. Like Lucas had been kind of owning more and more of the comms anyway. So that it was much easier. And I think it was just, we had the luxury just because we know Lucas for that long. We didn't have to rush it. And so I think the handoff was very smooth. So much so that like, after we left, like we absolutely did not have to get involved in the business whatsoever afterwards. Even though like it wasn't even in the most ideal situation, we left him the business because 3 out of our top 5 clients actually churned like 6 months prior to the handoff. So like I think in many situations that you could argue that like, oh, maybe we should have stayed longer to like stabilize and hand it off when it's ready. But by that point, we trusted Lucas so much and knew he was so capable, and maybe like and I think in our minds we're like, maybe he'll do a better job than us, frankly, and he has, and he's done a wonderful job since taking over.
Just general kind of thought that popped into my head there. Do you often find that the founder of the business becomes the bottleneck or kind of limiter to growth?
Yeah.
Okay.
Yeah, that's absolutely true. I mean, and I think a lot of that is wrapped up in kind of I'd say like it's self inflicted kind of a bottleneck, because there is kind of that kind of maybe human nature or desire to feel like you are important piece of something, and there's an ego element to it too, like like it's just won't be done right if I'm not the one to have to oversee it. And I think that at the end of the day is what keeps a lot of agencies small, is just kind of founders kind of unwilling to let things be done a bit differently. And there's if anything, there's no right strict way to do something. You can get to similar results or even better doing it differently. And I think it's that discomfort of like, that's not my way, that kind of keeps folks kind of like stuck from moving on from a bottleneck.
Okay. Talking now about kind of the CEO transition, do you have any thoughts that you could share on kind of finding that person, incentivizing them correctly to manage the business, and then how you manage them after you've kind of stepped out?
Yeah, I mean, I think and we've done a few hires and also identified from within at this point across our portfolio. I think first and foremost, just from a characteristic perspective, the thing that we have learned over time is that like you really need people who just kind of have that. I mean, it's kind of played out to say, but they have high agency, right? And what I mean by that is like there's like a certain impatience that like they just there's a bias towards action, and they're like, oh man, like I've been put in this situation, got to figure it out, like move. they crave like the feedback loop of like, hey, just, I'm going to try this. I'm going to experiment with this. If it works, great. If it doesn't, I'm going to learn. I'm going to try something again. And there's a constant motion to, there's a force. And, those type of folks where like, yeah, time is precious and, they're not going to, kind of pontificate and like, try to get a perfect plan. But they're just kind of willing to move. I think we prioritize for that, especially at the scale of the agencies, that we're at, which, it's a sub $10 million smaller agencies. And so I think that matters a lot. And then just from a kind of like, yeah, how do you align incentives? Obviously like we're very much, in this space because we like the cash flowing nature of agencies. And we really believe that, agencies run well, and, kind of set up well with good leverage, whether it's through AI or just other structures, can generate a lot of cash. And so we want our CEOs to be incentivized by how much cash flow they produce. So, we give them pretty, hefty bonuses that are tied to the cash flow that they generate. And so that way, they can generate significant amounts of income that, very much like ownership upside that they get with the business. And then, for some of the agencies, maybe, there's a point at which like we could get to a scale where we could explore an exit. So, they have some upside in that way as well. So, we always say, look, you get to a certain level, we'll, run a process and maybe, explore an exit. But in the meanwhile, we want you to make a lot of money throughout. And so, and that's tied on profit. So that's kind of the incentive structure and alignment. And then, you asked about like, how do we kind of, keep them accountable and the oversight aspect of it. Yeah, we keep it pretty simple. There's, at the start of every year, we align on kind of overall goals for that agency. So, that's usually kind of hitting on like, the revenue growth numbers, as well as like profitability, and then kind of the strategic initiative that they're going after. So, we'll review that. Maybe if it's too conservative, we might push them a little bit. If it's too aggressive, we might kind of, help them, just really vet that a bit more carefully. And then from there, it's weekly check-ins. We're just a sounding board. It's mostly a kind of coaching. And then quarterly, we have kind of a reporting cadence as well. So that's kind of the operating cadence that we have.
Okay. And is that the role of the kind of HoldCo? So, obviously identifying the opportunities and kind of assets, but it's really kind of coaching and managing the portfolio company CEOs.
Yeah, I think, I like to think, that's where we can be helpful just because like, Siwik and I, we have, a couple decades of having done this and, we can kind of pattern match a lot of the challenges and, support our CEOs in ways and kind of help them avoid some of the mistakes that we've made in the past. So I think that's kind of unique to like our kind of background and situation and having been so closely kind of, to the work as operators. And then, beyond that, it is definitely like the accountability aspect of it. And I think this is something that we missed when we were just, running the agency ourselves was, like, we might be like, hey, it'd be great to grow like 20-30%. And, sometimes we did, sometimes we didn't, and like it didn't matter. And sometimes you go, like the goals that you made, in January, by March, you're like, we're not gonna hit it, so who cares? And then you just kind of go. Here, like the accountability structure, I think has been helpful because we'll look and we'll be like, hey, your growth is great, your top line growth is great, but we can see that the margins are compressing, and there's some challenges here. Let's dig into that. Let's talk about it, and let's actually come away with like what actions are you going to take to address this. And so there's that constant bit of accountability and like just reflection on performance, and honestly like that's helped keep the numbers performant, because I think otherwise just left to our own devices we'd have some we could like we'll rationalize certain things and we wouldn't really look at it with hard kind of objective eyes. And I think I remember just like, our EBITDA margins might swing wildly or whatever, but like now, we're pretty, like we're able to course correct pretty quickly. And then also just like, you just run a tighter ship as a result.
Yeah. And for the CEOs, do you have thoughts on, is it better to hire kind of externally versus promote within?
I mean, it just depends. Obviously, I don't think there's a right or wrong, because you can have success and failures both ways. Like I'd say so. I prefer, so when we acquire an agency, my preference is that there's somebody already within the org that is so good that that person could kind of step up into the CEO role once the founder leaves. Like, so let's say, in a transaction that, it's a buyout of the founder. That would be ideal, but you know, you're not always going to get that. And the reason that's ideal is because, when you have a transaction where, you're bringing the agency into a new environment, people are, just naturally going to get unsettled, and they're going to be like, oh, like, what's going to happen? Are they going to, like, restructure us or whatever? And so it's really a vote of confidence in the team's culture and the team, if like one of their own kind of is the new leader, and then they can kind of, have that continuity and that trust with the existing team. I think I found it like, we've had situations where we've acquired a team and then brought in a brand new CEO, and it just doesn't mesh well, and you can have a lot of a turnover as a result. So yeah, it's just a delicate situation. And so in those situations, I prefer it, but you're not always going to get that quality person within that org. So sometimes you just have to take that risk.
Okay. Whilst running a transaction and obviously trying to kind of maximize the value that you get, how do you simultaneously kind of think through whether the founder stays, see if there's people in the org that can step into that CEO spot and kind of manage that transition?
Yeah, I mean, part of it is I think for us, a lot of like whether the CEO stays or not is a function of like how we're financing a deal. And so what I mean by that is, in the US, we have the for the deals that we're doing, we're leveraging the SBA 7A loan program. So the so there's some restrictions to using that that loan product, because you have to you can't keep the founder on for more than 12 months with if you use a SBA 7A loan, and they really can't be full-time employees during that time. They can just be consultants, because like really the goal of that program was to help people buy a small business and take it over and run it. And so it's really challenging, and they made it even harder to like roll any equity that people can kind of own a piece of it after the transaction. So when we use that instrument, we really do have to have a plan for who's going to take over as CEO. And that's where we really prefer somebody with, like, we'll try to look for a company, if we're going to use the SBA 7A loan, to look for somebody who can really take over from within. And then, but if we're not using that, and we're, let's say, using a heavier kind of seller note or, conventional loan, then, you have more flexibility with the seller, the founder, and you can have the founder, maybe even do an earnout. Maybe it's like, hey, stay on for 2 to 3 years. If you hit these targets, you get, paid X dollars, or, it's a seller note of sorts. And so, yeah, there's more flexibility there. But I think for us at our stage, like the 7A loans are attractive because of the terms and, just some flexibility around, the amortization period, which is longer than a traditional bank loan. We tend to want to go that path right now. So yeah, it's like a little bit of a complex answer, but it just really depends on how we're financing it. That kind of limits our options on how we treat the founder.
For sure. If you do go that 7A loan route, whilst kind of doing DD, are you kind of also looking at the succession plan kind of
100%, yeah. We have to, yeah. And we're like, and we've, there's been situations where it's like, if there's nobody there from within to take over, not because you could argue that you could still have to hire a CEO, but if there's not even like a management layer of any sort to kind of bridge that gap, then we're less likely to want to do that deal. So we do, like, if we're going to use that, we do want to see some degree of like leadership within the org that's outside of the founder.
For sure. Okay. I want to shift lanes now and talk about kind of how you view successful agencies. And I want to start by looking at the P&L. So what does a healthy P&L look like for you?
Yeah. I say generally, we want to start with like the gross margins, and, the way we like to calculate gross margins is basically like, you take the agency revenue, which is like net of any kind of pass through stuff. So the agency gross income, some people call it. And that minus basically like the cost of labor, because agencies at the end of the day is just people costs. Some people put software in there. I'm like just I think it's negligible versus the people cost. And so yeah, but who knows? That might change with like agent costs, like kind of token costs or whatever. So we'll see. But as of today, it's like agency gross income minus kind of the labor costs is like the gross, the gross profit. And so we look at gross profit / gross margin, and we like to see that healthy is like north of 50%, and like really good is plus 70%, and you start getting some really great leverage numbers. But yeah, let's say north of 50%. So that leaves you with, the other 50%. And out of that, let's say, I like to separate SG&A into like sales and marketing and like, general administration costs. And so you think about like, maybe 15% on sales and marketing and then 10% on G&A. It could vary. Maybe it could be like closer to 20% sales and marketing, 5% G&A, depending on how lean you run the overhead. So that should leave you with about 25% net. And so I think that's healthy. And if you could get to 30%, great. But and like I think you want to be investing, like you want to be smart about being able to invest in the sales and marketing at 10, 15, 20%, because that is what's going to ensure your future pipeline. And so sure, you can like juice it. So, maybe you bring down sales and marketing down to like 5%, and then you go, oh, cool. I had 40%, 45%, net. Like just from experience, I know that's going to look good that 1 year, but then the next year it's likely that, you're going to pay for that in some way with maybe a crappier pipeline or something.
And do you have kind of a target growth rate that you would say is, achievable, but not too toppy that it kind of causes problems?
I mean, it depends. Like, honestly, it's, there's so many factors to growth, right? I think, I think north of 5% is good in that, like, but it's also like, how, there's so many things to it. Cause the other thing beyond P&L that we look at really closely and it's aligned is the client retention. And so, like if retention numbers, are strong, then in many respects, like we'll look at retention numbers more closely, because then we know, hey, like this agency has the capability to grow. If your retention is poor, and retention like comes in many formats, right? Because like it could be business model dependent, because like part of it is like, oh, you just do projects, so you have to keep filling it up with new clients and then you're gonna just, it's a never ending game, so you have to be, the volume game of like attracting and landing new clients has to be really strong to make up for that. So there's the business model aspect. But if you're a retainer, kind of based agency, then it's more about, okay, how do you hold on to those people for, multiple years and, kind of continue to, maybe even increase prices or, expand those accounts. And so there's that degree of retention as well, like business model as well. And so once you kind of figure that out, then you can think about, okay, like what is the appropriate growth rate given that foundation that they have with retention. And then, and so if the retention is really great, like 5 to 10% is great, because you just continue to compound on, the existing clients, and, could go. But I feel like if you're mainly project based, there's like the risk that you're going to have some great years and then you're going to have some not so great years. And maybe that's part of it. There's a cyclicality to that agency. And so you kind of have to, accept that as a business model. Although many people won't, like, cause it's kind of like, wow, if you have, debt on that and you have to like stomach a negative 20% year, like, does that even map out? Right. And so, we like, I would probably avoid those kind of companies unless we're buying it without any leverage. So yeah, it's just, there's a lot that goes into those kind of decisions. It's just, really based on, like how you're buying it. And like, I think growth rate could be oversimplified. And I think it really has to be, seen with some nuance.
Okay. Talking of churn, I was at a conference in the kind of e-com agency space the other week, Could I get your thoughts on churn numbers, like monthly churn numbers? What do you think is kind of good? And this is for agencies that sell, an ongoing, you know, let's say Google ads for an ecom brand on a month to month basis. What do you think is a good churn number?
Honestly, it ranges because yeah, I don't know what's good because let's put it this way, like, you know, you can have it, you know, a situation of the crap in, crap out. So if your ICP is kind of like these businesses that, have or are themselves kind of struggling and, are basically, very sensitive to budget, very sensitive to the ups and down, like performance wise that you're delivering on a monthly basis and they can't view things long term. Um, well, okay, then maybe it is a pure volume play and like basically like you can lose, 5, 10, 20 clients a month. But if you can add, you know, 25,
Yeah,
30 clients a month, just like a little bit more, like that's, you're still growing, right? And that's okay. Like it's not, you know, so you could argue that's fine, right? Like, but let's say you're kind of enterprise grade and you have, some huge retainers, maybe even some concentration. You have like, let's say 10 clients, spending 100,000, a month on fees with you and then like doing millions in paid or whatever, right? Like for that one, like you lose one or two, it's devastating throughout the whole year. So you want to have like close to 100% retention and then be able to add a few on top of that. So I guess it really depends on the situation the client makes. And this is why like, yeah, like really knowing and dialing into who your, ideal client profile is very important.
okay. And in terms of contract length, how do you think that through? Because I think a lot of agencies in the space that I'm in, it is pure month to month. Do you like that model? Would you try and kind of get people to quarterly or annual? And yeah, what are your kind of
Yeah, this goes back to like the business model you want to pursue and like what's, you know, uh kind of understanding your client and also understanding like your own kind of reputation pull and like desirability as an agency. So what I mean by that is like even if you get a client to sign a 12-month contract, there are different versions of that, variations of that. Because there's like the 12-month with the 30-day out. And it's kind of like, okay, how's that any different than a month to month? Like in many ways, maybe you get the extra 30 days help. So it's a two, you're getting the extra month. Okay. But it's not a 12-month contract. It's actually a month to month with a 30-day out. Like that's what it is. You're just calling it 12 months and it's actually not. And then there's the actual ironclad 12-month, like, you're going to take them to court. You're going to be like, hey, in order to break this contract, you either got to pay the full amount, which is like the hardcore, very SaaS like, or, you might still have something that's like, hey, you still owe 50%. So, if you agree to spend $500,000, you got to pay, you got to make sure to pay the 250 to get out of it. So you might, and if you can enforce that, then that's more legit of a long-term contract. So it starts there with like, what are you willing to do? Because like, if you're actually willing to enforce, then sure, you can have long-term contracts. But then like, once again, during the BD sales process, are you going to, like, are you confident enough in your differentiation, your desirability as an agency to be like, hey, client, we only do 12-month enforced contracts. Otherwise, it's a no-go.
yeah?
Yeah, if you're willing to do that, then sure, go by all means. But like, I think most agencies kind of shy away from that because it is hard, and it kind of speaks to the commoditized nature of a lot of the agencies where they will say, let's do once a month, and we'll try our best because that's all they can hope for.
For sure. Okay. My kind of final question on the finance side of things are, I know that you guys want to take the cash flow from the agency, roll it up to the HoldCo level, but how do you think through kind of like reinvesting in the portfolio company? And I guess how much you kind of, cash or profit keep in the business and kind of reinvest is the.
Yeah, yeah. There's this is by nature, like what we've seen is that like it doesn't take that much to like reinvest, and I think we'll talk broadly about like, hey, what are some of these investments you're making and marketing and biz dev, and if a CEO makes a compelling case of like, hey, for this quarter, you know, I want to really, you know, put some robust spend around some of these marketing initiatives, and that because of that, like, the profitability is gonna, come down a little bit. That's fine. But our thinking is like, well, if you're good with gross profits, it's north of 50%, and you could get it a bit higher than that. Like, you can still kind of hit a floor of 25% EBITDA, and still have more than enough to spend on sales and marketing. So, we try to kind of push them on kind of that, track. But, sometimes, it might dip to like 15% or whatever. We just don't, you know, it is red flags if like an agency, is hovering sub 15% for multiple quarters. Like, it just,
Yeah.
we just think that is honestly, at the end of the day, it's like a gross margin problem. Like, you just don't have enough. And so, I think that they should have more than enough to invest there. But like, there's other things too, right? Like, I think because we sweep cash to the HoldCo, it like prevents like certain things. Like, we don't like it when people like try to hire too aggressively ahead of demand. And, so what it forces them to do is like, hey, always be recruiting. That's fine. But also always be like, building out kind of the network of like flex talent, contractors, freelancers, just other agencies you can white label, whatever. And, lean on those folks for as long as you can until you have more stability in your revenue to kind of support a full-time hire. And so, I think those are just kind of good, kind of, best practices for them to be, smarter about how they spend money. Because we've been there before where we're like, oh, look, pipeline looks fat, let's overhire, and then like, some of that doesn't materialize, and you're and you don't cut staff fast enough, like you're gonna burn hundreds of thousands of dollars like really easily.
Mm-hmm. Okay, so it's kind of case dependent, and you want to see like a business plan from the CEO if you're going to allocate significant capital to a reinvestment.
Yeah, definitely. Like, it's just, not even like anything as formal as a business plan, but more just kind of let's talk it through, and like let's get an idea of like, it could be like a short kind of memo with some bullet points.
Okay. And in terms of where that capital for investment is allocated, obviously you talked there about kind of increasing the sales and marketing spend. Will you look at kind of other investments like a new service line, or kind of what else would you invest in?
Yeah, I mean, new service line, if you think about that, like, it still is a sales and marketing expense, because the moment, like, there's a go-to-market aspect of it, and which is all sales and marketing. And then once you land clients, it should pay for itself. Like, so that's the beauty of like agency. There is no like real CapEx. It's like, and just the way that a lot of the work happens, where there's the cash flow, the cash conversion cycle is like, pretty advantageous for the agencies. Like, you can get most of it up front. Like, I think it should be self-funding. Honestly, the clients, if you get it right and there is some kind of service market fit, like, there shouldn't be much of an investment outlay.
Okay, I like that approach. Talking of kind of go-to-market sales and marketing, how do you think about the kind of different lead channels, and what have you seen that you really like in terms of those channels?
Yeah, I mean, I think the most under-invested that we see time and time again is along the partnerships side of things. And I think part of it is like agencies not having a clear understanding of the ecosystems they belong to. And it's it's kind of like knowing that, let's say you're in like retention marketing or something, then okay, cool, there's like obviously some of the platforms that you might play in, and there's the ecosystem there of like partners that might send you leads. But then there's also kind of like, hey, within the type of businesses that you serve, so let's say if it is, let's say, like consumer brands, right? And especially with the e-commerce bent, okay, well, those companies are going to be working with these types of other agencies, whether it's branding or packaging, or paid or web, whatever. Like, those are all potential partners too, because then as a retention agency, you can send those folks work and they can send it back. And like that, like just cultivating those relationships and keeping in touch with them, understanding what they're doing, being able to send them leads so that they send you leads back. Like that in itself is could be a full-time job, or like could require multiple people to service that properly. And a lot of times agencies do that like kind of you know, kind of half-heartedly or like just really haphazardly, and just like, kind of like do it at a surface level, very transactionally, don't really pay much attention to it. And then they go, hey, let's invest a lot of money on outbound cold emails and try to, blast, along with every other company out there, like a million emails, and see if anyone bites. And I think that's just, like there's value in cold outbound, but like I think like the partnerships angle, like there's just so much underinvestment there that, a lot of low hanging fruit for folks to invest in. So yeah, that's one of the things we look at, initially with any agencies that we're trying to acquire, or, even across our own agencies, like how much more can we do? And remember, if you keep thinking about your ecosystem, there's a wealth of other partners besides agencies and the tech partners. There's also like, hey, are there content creators or influencers, fractional C-suite folks, consultants, investor types, PE, VC, like all those are partners that, can, if you have a relationship with them, they can transfer some of the trust the brands have in them to you, and the leads are such much better quality, right? The associations, conferences, events, expos, like all those things are ecosystem kind of opportunities, and that's where partnerships can come into play.
Okay. And do you have any tips for like building out that kind of relationship? Let's say it's with a partner agency. How would you go about building that kind of relationship?
Yeah, I mean, it's not something that's like, hey, let's sign this 10% referral agreement. I think that's kind of the wrong way to think about it. One is kind of understanding, first of all, like, is there alignment in, kind of the type of clients, number one, the way you work, the quality of the work, and, just there has to be that fit of like, because sometimes, if your agency is like meticulous about, the relationship, the work that you do, but then this other partner is kind of, like maybe they're churn and burn kind of a agency that just like is all about the volume, very flashy marketing, that's probably not a good partnership. But so you want to kind of mirror the type of agency, values that you guys have in the partners. The best partners are ones that are like, oh yeah, like we really trust each other because we know that we really care about the clients in the same way and kind of care about work quality in the same way. I think that's one way to look at it. And then, yeah, just genuinely taking the time to know what they do so that you could become their best, basically, sales folks, and vice versa. They really take, like interest in what you guys are able to do and know who your, best clients are, what your best case studies are, and just being able to be conversant. And so if you think about it in that respect, like there's a lot of education you got to do with each other, which means there's a lot of communication and kind of relationship, work that needs to be put in to make a partnership really, really, really work.
Okay. And do you have other channels that you like outside of kind of outbound and partnerships?
Yeah, I mean, I think it's always worth testing. And once again, it's like also depending on what you're selling, who you're selling it to, what's the cadence of buying, and so, for example, I have a friend whose agency, kind of does like video testimonial stuff. And, they have found a lot of success with like LinkedIn ads targeted at B2B, marketers. And, just you can build a really scalable, effective process because, it's a very productized offering. And, you can scale that nicely. So, for agencies that have the right service for that kind of channel, I think it works. But, for most of our agencies, that probably doesn't work. I think podcasts have been pretty good for some agencies that, just use it to really connect with their ICP, maybe even partnering with, certain creators in the space and doing a podcast with them could lead to, interviews of, brand leaders that can lead to more work as well. So there's tons of channels. It's just, once again, going back to like, what is the type of thing you're selling? Is it more transactional, or does it sometimes take long relationship development? And I've seen people like who've been very focused, like some might only do, for example, like the like their own TikTok channel and be very educational and, kind of reach different brands, but, maybe they're targeting kind of more earlier stage, like founder led companies. And, that could be an effective channel as well. Just, yeah, there's no kind of limits to what channels could work. It's just kind of making sure you know who you're selling to.
Okay. And from a kind of macro point of view, how do you think through kind of channel diversification versus, focusing on just one? And, are you saying to your CEOs, like every quarter you must, test a new channel or something like that?
Yeah. We're not too prescriptive on that front. There's obviously like there's some basics of like, let's make sure, first of all, um, like where like I mean, I think the number one channel of anything is like let's first make sure like you're still getting organic like client referrals. And so that's number one channel. So we always go like if you don't have that, it probably means you're not doing good work for clients. You're probably not building good relationships with clients. So you got to there's like deeper things you got to fix in order to get that channel going. And then, like I said, partnerships is the other basic thing that we go. And then, so we go like, we always go back to the fundamentals of like, hey, do you have, your clients, your, partnerships, you have that dialed in? Okay. Now on top of that, you could layer on some other stuff. And, every quarter they might experiment with one, if not two kind of things. Some of our agencies might test, might be like, hey, like, we got some positive signals from like AI search. Maybe we got to invest a bit more in there. Okay, cool. Like maybe we start putting spend there. Or hey, like we we want to do a little bit of like a account based kind of outbound motion where we have like these 10 brands and we think we could really map it out and go after them in these ways at these conferences and this kind of outreach motion. Cool. Like that's another experiment. But yeah, so that's all fine. But like, I think one of the things that we also kind of, caution them is like, don't try to do too many different things and, don't skip the basics. Cause like, yeah, you can get, attracted to a lot of shiny things that other people are talking about online and try to imitate. But, there's the basic stuff that you got to always make sure you're doing.
Okay. Would you ever centralize the marketing function at the HoldCo level and kind of apply it across the portfolio?
Now, I mean, like that is something that like, I just don't think, first and foremost, it like removes the accountability of our CEOs. Because like I'd feel the same way because it's like, oh hey, we'll take care of the marketing and the BD. And if you have a crappy month, you go, well, like you guys said you guys are taking care of that for me, like, and so I think this is why like we really do believe in a decentralized model. If we're gonna, have our CEOs feel like CEOs versus like kind of, a GM or somebody just kind of, manning the operations, but like, somebody who can own the vision, the strategy, and like really, the positioning of our agencies. We just need to be pretty hands off.
Okay. Obviously, the next step once you have the leads is kind of the sales and closing. And I know I've seen a lot of content for you about kind of pricing on value rather than deliverables. Can you just talk through your kind of thoughts on that and specifically how you're getting them to?
Yeah, I don't, and I'm not like a dogmatic like value price kind of fanatic in that way. I like to think about it as more like, hey, look, there's, when a client goes to get, something done, like some problem solved or something done because like they're trying to make progress in whatever they're doing, right? Most of the time it's they're trying to hit some kind of goal. They're trying to, let's say it's, they're trying to run a campaign of some sort, or they're trying to, like there's a new product coming out. So they need to, support that launch. There's usually some kind of objective slash some kind of overall goal that they're trying to achieve. And, within those confines, they have that like bigger economic number. And then they, off of that, they're like, okay, this new product is going to, hopefully in the best case generate, a few $1,000,000 of incremental revenue. The amount that they're going to be willing to spend on, let's say, a website build or like a paid marketing campaign or whatever it is, like is probably some fraction of that. And so, you just kind of have to have that convo with the client of like, look, like you guys probably have some value prescribed to this. And, like we can play the game of like trying to you know, scope the project on the work and then hope that that matches. But a lot of times you can have that conversation up front of like, you know, first you can throw out some numbers, right? As an agency, you can be like, hey, like typically for these things, you know, where and you know, you're taking some signals, right? You can be like, all right, like this company's this big, you know, and they probably, you know, for this kind of launch, they probably have allocated this kind of budget. You can even ask. If they don't give you, you can still guess. So you're taking all these signals and you're like, all right, for typically for this client, for this kind of situation, you know, we might price whatever, let's say 150K or whatever, 200K, right? For that same work, for a much smaller client that you know has probably a smaller outcome or whatever, you might price it. You might like realize, okay, they probably have nothing close to that budget, so it might be a much smaller budget for that same work. And like, you know, as long as the work you're doing costs a lot less than that and you have sufficient margin built in, that's really what I think about as value pricing. Is it's the value to that client that you're able to discover as a price. And sometimes the client will tell you, they'll come back and they'll be like, you know, all you have is 100K to spend, you know? And it's like, well, let's talk about it. And you might be like, and this is where you could get more into the games. And obviously, like, you know, someone like Blair Enns has written a lot about this in his books. And, you know, you could give them options. You could be like, all right, cool. Well, here's a 150K option and what you have gotten. But then, okay, here's the 100K option. And then, by the way, here's a 75K option too, if you want to go even lower. And these are all priced with sufficient margin. And this, it goes back to like, you have to be really creative in being able to do the work, you know, with a certain amount of margin discipline, so that the pricing becomes a like almost decoupled. And so, yeah, like, you know, some of the best things is like, you know, if you can do a website at like, let's say 15, 20K of costs, but still charge, you know, 250, 300K for that, that's great. You've done a good job. And then sometimes you might be only able to charge 50K, but that's fine too. You still made good margin. And so it's kind of, that's what I think about with pricing. Hard to do, but then once you get into the, let's try to cost it out, get your team to like, you know, just put in hours, and then you go, okay, let's slap on 25, 30% margin on top of that. And then hopefully the client says yes. You're also inviting a lot of bloat into the process. And you're also like not challenging the team on how to think about doing things more effectively and efficiently. Cause then, you know, you're working back from a very agency orientation of like, oh, this is how we think about it. We do it, what's important to us. And, you know, at the end, it doesn't, like, who cares? The client just wants, you know, what is going to move the needle for them, what's going to, you know, make progress for them.
Okay. So is this entirely kind of custom, or is this, you know, you have an agency, it has a certain product suite of, you know, product X, Y, and Z, which cost, you know, price 1, 2, and 3, or not? Which way?
Yeah, no. So this is a little bit of nuance. You internally, you can create these kinds of, you know, you could productize in many ways, right? And so you go, look, we have like an audit thing, we have like a ongoing retainer thing, we have this project thing, right? Migration, implementation, whatever. So you can create all these, and you can be like, all right, here's like a simple version, complex version, or somewhere in the middle. But they all, and you've like streamlined it, and you can like pull it out, basically, right? But the way you price it to the client, there's a psychological game of understanding what the value is to them and then trying to get that local maximum. You get what I'm saying? So it's almost like, yeah, like, you know, it's not that different from, if you think about the airline analogy, right? You do have the, you know,
Yep.
first class, business, and then economy. And you're like, all right, like you're going to get clients that are kind of, you know, in those camps, but like within that, the pricing can vary based on what they're also willing to spend and, you know, the situation and all that stuff, right? So, you know, somebody might buy economy for like the cheapest price because they're, you know, coming in super early, booking it early, but then somebody who comes in much later into the flight, they could still get that economy for pay a lot more, right? And it's so dynamic pricing is kind of the game. And you know, I think just, you know, that's just one of many ways to think about pricing to kind of, you know, get more of that capture. Because, you know, in the end, if the client feels like they're getting their consumer surplus, you know, they're getting, you know, their value, doesn't really matter, you know, what they're paying. But then it could be done in a way that's advantageous for the agency as well.
Okay. So would you almost say you kind of build out your packages and your offerings, which then is the kind of base price, and then you're trying to figure out the pricing elasticity of the.
Base cost. Yeah, like you understand the cost structure of that, and then you go like, look, we can't fall below this threshold, but then really the name of the game in sales is to figure out how far we could take it upstream and capture more of that as much as possible.
Okay. I really like that airplane analogy, by the way. I think that's a really smart way of looking at it.
Yeah, I mean, that's he talks about this a lot. Ron Baker in implementing value pricing. He talks about that a lot.
And I guess this kind of brings me on to my next question about kind of, upsells and kind of add-ons. And yeah, I'm going to start with a kind of product suite. So first off, how do you think through like an offering? So for us, we're obviously, single service agency. What do you think of the value there versus, let's say a full stack marketing agency in the consumer space, ads, email, web design? What do you think about there?
Yeah, I mean, I think there's a place for both, and it really goes back to like, hey, like what does a client value, and like what is going to help you differentiate you and position you more effectively in the client's mind. So you could argue that certain clients, they might be looking for a best in class in a certain capability. And so if you can position yourself as, hey, we only do this, we only do retention marketing, we only do performance marketing, and we're the best at it, and here's all the proof points showing us why, like that could be pretty effective, right? And you can kind of position yourself to only work with the clients who want the best of that single service and always win out versus the more full service, full suite folks out there. But on the flip side, you could be like, hey, look, we're pretty good at all these things, and by the way, because we have all these things, they all talk to each other, and there's certain benefits you're just not going to get from a single service agency. And so you're going to get this kind of team thing. You're going to get kind of the strategy that's kind of even more layered in sophistication because of the way we do data across all of these different services and channels. And so maybe that's a different sale, right? And then furthermore, you can go another dimension to it, which is like, hey, not only do we do this either full suite or single service, but we do it for this very particular niche kind of industry or vertical. And so like, hey, we only work with, let's make it up, but like we only work with like footwear brands. And, we have like, we know the buying behaviors of customers who buy footwear to the degree that like no other agency does. And that's why, you footwear brands should work with us. And so you can have another kind of very focused, approach. And so, but then you can also juxtapose that with a full service agency that goes, hey, we do if you're a footwear brand, you should work with us because we do everything for just footwear brands. And so I think, like there's a lot of things you could do on the positioning side. And, you see this all the time of like, why is it that you can win in both ways, because, you could be a single service agency, do really well, and at some point you're going to become an attractive acquisition target for somebody bigger who doesn't have that capability, and you could plug in. And guess what? Now you're part of that bigger offering. So, I kind of seen that play out both ways.
Okay. And in terms of the kind of product offering, what do you think about kind of, obviously, most of the agencies, I'm assuming you have a fully done for you services, but what do you think about kind of done with you consulting, advisory, and, kind of other offerings beside that?
Yeah. I mean, I think those are all viable and, like, good options to test out. It's again, like it all depends on your ICP and like, who you're actually working along with. Cause I think there's sometimes like, I think done with you, sometimes, sounds good on paper and clients kind of get attracted to it because they're paying less. But, like you could have an ICP where you're set up for failure with that because they might be like, you know what, I thought I could do it, but, this is way too much. And like, can you do it now? Then you're going to have another talk about the budget and, they might not be happy about that, et cetera. So you just have to know, like, but then there are others that are like, oh yeah, the done with you, or do it yourself even of like, hey, hand off like some kind of guide or manual, and we'll do it ourselves. Like that that could be successful if it's with the right kind of folks. And so you got to really vet that right and make sure you have the fit there.
Okay. Moving on now to your kind of, acquisitions process and kind of what you're doing at the HoldCo. The first question I have here is very kind of macro. So I know you kind of, over time started to work more in the consumer brand and e-commerce space. Was there ever a time when you kind of wanted to start your own brand, and why didn't you go that route?
No, I mean there was a brief stint where like a few friends and I we tried to like get a supplement brand going, but like I just knew right away. I'm like, oh, I'm not into this. Like, this is not like, as cool as it sounds. And I'm like, oh, I need the motions of it. I know like you got to create content, you got to, make like a converting website, you got to growth hack in these ways. I'm just like, I don't, and I just, part of it was I just don't, I'm not as passionate about the physical, like
Yeah.
the product. And that was good. It was a good experience in the sense of like, I was like, wow, what I do really care and passionate about is this realm of like, professional services, creative firms, like these kind of, agency model. Like it just kind of, underscore that for me. So yeah, just some people love like the tactile aspect of like their own brand and like seeing it on shelves and stuff. And I realized I'm on the other side of it, which is like, yeah, I love like teams. I love like this idea of like expertise. I love like helping other businesses find success.
Okay. The next kind of macro question I have comes off the back of a podcast I did with Eli Rubel. And he basically said, he doesn't want to buy agencies at this point because he's worried, AI is going to come and kind of massively disrupt them. And he would much rather kind of start from scratch, anything new, and kind of build it up. What would you say to that?
Yeah, no, I think those are valid concerns. And like, I think this is why like we do, look at spaces where we think, there's a bit more durability or like, kind of a like they're already, incorporating AI in a way. I think, and they're also small. Like the agencies we're acquiring are not big, so there is a nimbleness to them where they're small enough that they're able to continue to refine, incorporate AI, and kind of move pretty quickly to adopt and evolve different ways. And so, I think Eli's right in that. Like, yeah, I'd be hesitant to like kind of buy like a legacy 50% dev shop or whatever 100% dev shop today, because that's very much I think gonna be feeling some pressure. But a 10-15 person let's say digital marketing company that's like really focused on a particular niche and has really loyal clients, and uh and the clients aren't that tech savvy, like I think those are still good bets, because the agency's got to be moving much faster than the clients on the AI side, and can actually just be that guide and kind of conduit for them to take advantage of AI if instead of replacing them with it.
Mm-hmm. Talking of AI, is there anything you're doing at kind of the portfolio level to kind of prep the businesses for what's coming in that space?
Yeah, I mean, I think we're always talking about how AI can be, better leveraged within the workflow and kind of the value we deliver for clients. I think what's exciting these days is like some of our agencies have really taken to creating their own tooling to kind of give them more business intelligence across the agency. So kind of custom building their own kind of something of like an agency OS where they might get more constant updates or have a pulse on client sentiment, like just client profitability, just and account health, things like that. So I think that's cool to see, and it's fun to see how like each company adopts and addresses it, because it's not just cookie cutter. And I prefer this way of like, instead of top down being like, hey, here's this AI tool everyone has to use or like whatever, it's like they're kind of building their own thing. And the beauty of it is if you help, what I try to focus on is like help cross pollinate by having them share with each other, and that spurs even more kind of innovation and creativity and knowledge share.
Okay, and so is that what you see your role is not like hiring an AI consultant and kind of plugging it in? It's just sharing ideas amongst everyone.
Yeah, sharing ideas. And if I do hire an AI consultant or whatever, it might be to come in and just like talk about what that person is, seeing in other places to just inspire and everything. So it's always about first like knowledge share and inspiration. Because like I said, it goes back to, accountability, ownership, and just like this idea of like, hey, I'm running like this is my agency. I'm running it, and I wanna try this, and this is this like you take away that kind of that independence, they're just less likely to want to try stuff.
Okay, no, I like that. Did I, or am I correct in saying that you previously kind of did build a lot of these agencies from scratch and kind of moved away from the venture studio model?
Yeah, exactly. So like I said, like the first few were all kind of built from the ground up. So obviously Barrel, my first one, Vaulted Oak, and BX Studio, and then we had like a brand design agency called Bolster that we also launched from the ground up. We've since exited that business, and then we also kind of rebooted an agency. So we acquired some of the trademarks and kind of client like assets, but like we that was essentially like a startup as well. We've closed that one, and then yeah, and there's another one that we had started as well, but like we just kind of pulled the plug on that early just because we decided that the acquisition path was the more viable path for us.
Okay, can you just explain why you prefer acquisitions now versus start from scratch?
Yeah, I mean, I think part of it is like just the path um to first of all like this selecting the service, and then the go to market, and then trying to get to the critical mass needed to make it matter, which is like, can you get it to a couple mil of revenue? It just felt too much of a crapshoot of like, we got lucky with the first couple that we did, and we thought that would be the norm, but it wasn't. And like the next few were harder to execute. And you know, instead we realized like you can actually find good value in agencies that are already there doing 2+ million in revenue with with profitability that we could acquire and then take them to the next level. And so and at that point they've kind of have some degree of service market fit where they're like they've been around for 5+ years, and they've kind of established a client base and a revenue base. They have the capabilities and a degree of expertise, and so yeah, we like that. Like we just like that someone else has done that work, and they get compensated for that, obviously in the transaction, but that kind of de-risks. It comes with other risks, but it kind of de-risks that kind of opportunity cost of like trying to stand something up and taking a while.
Okay, so this is almost just the lane that you prefer to play in.
Yeah, I think so. I mean, and you just honestly like I've learned a lot more doing this because in the process of doing M&A, you just talk to hundreds of other agencies and you get to learn, what they're doing and how they're constructed, how they're performing financially. And so just that in itself has been super valuable because then, I'm like, oh, met this agency, which, like maybe they're not ready to sell or like they're too expensive for us. But guess what? I picked up some interesting things about what they do. And that's just kind of great kind of knowledge share with the other agencies in a way that's, obviously like sensitive to any confidential information, but just kind of like concepts, right, come about. It's like, oh, like the agencies are, thinking about, I mean, they're able to do, they structure their services in this way that's been effective. And it's kind of like, all right, how do you kind of abstract that knowledge and share it with our agencies and make them better?
Okay. Can you talk to briefly kind of your process for finding and evaluating the deals?
Yeah, we have we've invested a lot in kind of like the deal flow aspect of it. So, first of all, like the activity on LinkedIn obviously helps a lot. I get a lot of inbound from my content on LinkedIn. And then we work with a buy side advisory firm that does a lot of outreach on our behalf, so they're able to get us a handful of leads every week. And then beyond that, we continue to build out our network of like brokers and finders who are bringing us deals. and then get paid a commission if we go through with the transaction. And then just being our agency habits website, which has a lot of resources for agency leaders, and that is a list that we're always trying to grow. We have a podcast along with that as well, so that because has built up an audience. So like when any of those folks who regularly consume our content are thinking about a sale, that we've built enough of a trust, and we've kind of become a enough of a resource for them that they're comfortable reaching out to us and having that preliminary conversation. And so I think those are all kind of the assets that we've invested in that have been helpful.
Okay. And in terms of kind of evaluating deals and what you're looking for, what does that look like?
Yeah, I mean, I'd say like there's two tracks. Like the first one is obviously the these specialized agencies that we want to bring into the fold as standalone agencies that aren't that retain their brand, hopefully retain most of their team members and the culture, and they're either focused on some kind of platform or some kind of vertical niche, and they're doing typically $500K to $1.5 million in EBITDA, and so revenue wise it's probably, let's say, like $3 to $6 million in revenue, and so so that's one track. The other track is more like tuck-ins for our existing agencies. So, it might be like a smaller Amazon agency, or it might be a smaller, Shopify, or, Webflow agency that might tuck into one of our existing agencies.
Okay. And are there other kind of criteria beyond that, like, client concentration or price point, service mix, or is it just kind of dependent?
Yeah, there's a lot of nice to haves, honestly. But like the thing that we've learned over time is like, no agency is perfect, and there's always some hair on these deals, especially, there's, first of all, they're small, right? And they're small for a reason. And so we've, most of it is a lot of agencies at this size, they've done a good job getting to a certain number of clients, but they're probably underinvesting in sales and marketing, and they don't have a good motion there. So that we almost always realize that's something that we're gonna have to do some work on. And then, client concentration could be a problem for some of them, but then, if they're like tuck-ins to an existing, if they're being tucked into one of our existing agencies, like the client concentration problem gets kind of solved to some degree, where it gets blended with the existing client roster of the absorbing agency. So yeah, there's like ways to mitigate it.
Okay. Are there any like major red flags that will, too much hair and you'll just kind of walk away?
Yeah, it goes back to like what I said earlier about client retention. Like if you're an agency that can't keep clients, or like clients, or let's say even if you're like project based and you just you don't have any reoccurring client relationships, or you have like no client referrals, like those are all red flags, in that like you probably don't do like you're probably not expert in what you do, or B, like you just have probably horrendous client service, and so like your reputation is not going to be great, and those are ones we'll stay away from.
Okay. Once you've got the deal, you're kind of starting to look at it. It's past the initial screen. What does your due diligence process look like, and then how do you think through structuring that acquisition?
Yeah, there's like the pre-LOI diligence where we're looking at their finances. We do a check on their retention numbers, and then you just kind of get a sense of their team. And then once they sign the LOI, then it's a much deeper dive. We have a bunch of docs that we request, and we're kind of getting a lot of walkthroughs around kind of the team construction. We get to learn about each of their clients and what they're doing for them, and any kind of irregularities, or kind of just quirks that we need to know about. And then we use a third party for quality of earnings, best practice. We'll also just get a understanding of each of the team members and their strengths, and kind of like what usually like there's only so much you can do, because there's a lot of like kind of confidentiality, and you can't get access to every team member directly, but like we're basically really getting the download from the seller, the founder, and relying that he or she is kind of being forthright with their answers. So there's a bit of that, and then there's some stuff that we'll do on our own, just kind of poke in, try to look at various other sources, whether that's LinkedIn, Glassdoor, and other places, to see what's what's said about the agency. So yeah, there's stuff that we'll do, and then yeah, really, I mean, like the retention numbers though are most
Yeah,
revealing because like you know you it's hard to have a good agency. I mean, it's hard to have a bad agency if you're able to retain like the majority of clients for multiple years and they have good relationships with you. I think that that's always a revealing trait of agencies that we want.
okay. And then in terms of that kind of deal structure, how do you think that through?
Yeah. I mean, just going back to some of the options that we talked about with financing, with if we're using SBA, it's it's going to be pretty like front loaded. They're going to get a lot more cash at close. It might be anywhere between 70 to 90+% cash at close. But if we end up doing some other structures like an earnout or whatever, it might be less, like sub 50% cash at close, and then some other means of paying them. So yeah, like I think it just depends. And I'd say like, yeah, if it's a heavier kind of structure, that like backloaded structure, then I think that might be reserved for more higher risk agencies.
Okay. And I think I've seen the numbers of 2 to 5x is the kind of valuation range that you guys look at. Is that correct? And what can see up to that range and get it closer to 5x?
Yeah, I mean, it's not an exact science. It's not like you have some kind of point based rubric and you just kind of go, oh, you hit this number exactly. It's like people are going to pay what they want to pay and how much they want it. So for us, we have to be disciplined buyers because we're not swimming in excess cash to like just go and irresponsibly buy agencies. We want to make sure we get a good return and there's a margin of safety that can pay down whatever debt we have on the business. And so we're like 3 to 4 honestly is like 5 is, you have, like, for us at least, 5 you have to be like, the growth rate's got to be amazing. You got to have retention like that's just rock solid, and you just, the margins have to be awesome, and just for us you got to be hitting all cylinders. But by then it's probably not that competitive for us. We're not competitive, and those folks might get higher multiples elsewhere. And so we're really looking at 3 to 4. They probably have some work to do on the like I said, underinvestment of sales and marketing, but they have good retention. And I think if we feel good about your management, like leadership layer, and we think the handoff from founder to their second in command is going to be really good, and we feel good about it, you're going to get a better, you're going to get the 4x, the upper end of the 4x to maybe 4.5 from us. But if you're missing all that, then we're gonna take that risk into consideration and be like, hey, like it might be like a 2x or something, and we'll start there. And a lot of times that might be too low for folks to consider. But then again, they might be in a situation where they really do want to get out of the business, and sometimes that could work out for us.
For sure. Shifting gears now and talking about the kind of post-acquisition period. I guess my first question here is there kind of like an overarching investment thesis and, hold goal, sorry, in terms of time and kind of exit strategy? And what is that?
We try to look at it in like, what's kind of the, what's the realm of possibility in 3 years? And, we'll have kind of like hey, like this is kind of the big, like hairy goal in terms of like, if we're able to big hairy audacious goal, if we can like kind of really push us and everything goes right, like this is kind of where we can think about growth. We'll do that as a starting point, but like that is more to like kind of prompt discussion on like, hey, like what is the appropriate strategy and where should we be investing in the agency now to kind of spur more growth. But like I said before, like we might look at the characteristics of business and be like, look, we're fine growing this at like a 5 to 10% clip for the next few years. And like, if we can hold this for the next 7 to 10 years and, it's growing at that clip and you're able to maintain profitability, it's going to be a home run. In other places, like we might be like, wow, this has like the bones of something that can really, really scale and we need to go all out for it. So we might be like, okay, cool. as soon as we acquire this, we're going to go for a tuck-in acquisition or something. We're going to look for some kind of a big growth lever so that, we can add 30-40% to this year over year. So yeah, it just depends on the business characteristics and what we're looking at. It's very opportunistic because like at the end, like one thing that we've like resolved on is that the opcos, the companies in the portfolio can either be like, short term for us with that, which would be like 3 to 5 years holds that we exit, or long term. It doesn't really, that could vary and will be opportunistic. But what's long term is the HoldCo. Like the HoldCo as an entity is going to exist for a long time is how we're designing it. And so the really like, as long as the HoldCo is just kind of continue to allocate cash in a smart way, there could be variance in like how we treat the agencies and, can be opportunistic with it. Because yeah, you might argue like, let's say, for example, we get into a certain space, just like take Klaviyo, for example, or whatever. So you buy like a retention marketing agency with a, in the Klaviyo ecosystem, and you go, wow, there's some kind of consolidation play happening where, there's a big player that's like trying to buy as many of these Klaviyo agencies as possible. And, let's say we're able to scale a Klaviyo agency to like a couple million in EBITDA. And all of a sudden it's like, cool, someone's willing to pay like 8 to 9x for it. Well, we bought it for 3 to 4x, and like someone, 2-3 years later is like willing to pay that much. Like, we're not going to be dogmatic about it, right? We're not going to be like, hey, we're only a long-term hold only, blah, blah, blah. Like we're going to be like, no, let's think about this. And what's the implications for the people, the CEO and others in the team, if they're on board and, it feels good, like we're going to explore that. So like I said, opportunistic and, like being pretty pragmatic about the game. And, the only thing that really matters is that the HoldCo is here for the long term.
Okay. And what is the long-term goal for the HoldCo? So like, where do you want to take it?
Yeah, no, I mean, like we think, we're thinking sky's the limit. Like we want to, grow, like we have 5 agencies now, and, like low 8-figure revs, right? And so it's like, hey, like, can we get revenue to, 9 figures? Can we get EBITDA to 8 figures plus? Can we get, a dozen plus, 2 dozen agencies? And so, that's kind of, the ambition is like, let's continue, let's build the machine, build the engine that will continue to let us, continue to invest and grow in a smart way.
Okay. And at the kind of operational role at the HoldCo, is there kind of more people, positions, or functions that you would kind of take on at that top tier?
Yeah, I mean, so we have like, we've invested in, we have a head of like M&A who like helps to screen out a lot of the initial kind of like conversations with agencies that are interested in being acquired. And then also works on like the modeling aspect and due diligence and other, just all M&A related activities. So we have somebody doing that to support what me and my co-founder Sewuk do. We have like a portfolio ops manager just kind of helping to support on some compliance and kind of like legal and HR matters, just supporting some of the agencies who don't have that function internally. So we'll support some of that. We have a finance person who like is kind of fractionally helping all the agencies, but then also just supports at the HoldCo level to make sure all these things are consolidated in a way for us. And then we have a person, a GM dedicated to agency habits, which basically is like our marketing arm, you could say. So yeah, so we have a small team that I'm sure will grow, and we'll probably end up like building out some kind of a like a general and there's a group called Chenmark that like has a portfolio of small businesses that does this really interesting thing where they have like these general VPs that they basically MBA folks that they bring on and place in different portfolio companies as like executives as a way to train them up to be a CEO of like the next business that they acquire. We've thought about something like that, or at least as a pipeline to build leadership for our agencies as well, because our agencies as they grow, they're gonna go from being mainly CEO dependent to needing a COO, a chief revenue officer, like some other type of like C-suite role or VP role. So just being able to provide that through our own homegrown, like somebody who's been in that system, could be pretty powerful. So that's something that we're, thinking about for the future.
Okay, nice. Peter, as we start to round off, I wanted to talk about some of the content stuff that I've seen from you. So the first thing I think I read on your site was the personal mission statement, and then also got to like the operating rules that you have. Could you just the kind of importance of having that and what it's meant for you?
Yeah, I think part of what's been very gratifying and fulfilling for me is like kind of just having gone through, and I think part of it was a function of just like having read some good books that really guided me towards this is like just carving out space in my life to reflect and think about what's important to me, and a lot of it is like how do I want to live my life? And so I think that has become a big, question for me over and over again. And writing helps me to kind of, organize those thoughts. And so, part of, the mission came about because, like I've read a bunch of things where like, what really creates, happiness is just living a life with purpose and meaning. And, I was trying to really think about what that means for me. And I think, if I was to categorize, like really describe it, I always felt like, it's being kind of that facilitator of, other success. And, kind of like I talked about, what got me interested, in doubling down on the agency side is like, being able to facilitate the success of our clients. That's been huge. And today, like being able to facilitate the success of our CEOs of the sellers who want to sell their agencies to our HoldCo, and a lot of others in between, right? Even with agency habits, I want to play a role in helping other, agency owners, do better in their businesses. And I think the content we put a lot of effort into like sharing as much as we can because we think it does that. So yeah, it's been a good guiding principle. And like, I think it just brings meaning to my life. And, just the other stuff, the operating rules is, it's just collection of, hopefully for me, it's wisdom of like, hey, like these are things that, just through trial and error and just having lived life, have been effective for me, whether that's kind of, the way I regulate my emotions, the way I treat other people, the way, I take care of myself, all those things, kind of, add up over time. And so, yeah, just being able to articulate that, reflect on it. And, it's never, static, things evolve and change as life changes, but just the practice of doing that has been really rewarding.
For sure. The final point I have, and just touching on what you said there about kind of reading and personal development, how do you kind of find coaches and mentors, and what have you found best to kind of reinvest in yourself?
Yeah. I mean, I think, just the content you consume is like, I think first and foremost, just because we all, as, as humans in this, age of like, limitless information, I think there's a, the way you curate and read, some of these like more time tested books, following some folks who kind of, align more with your values. I think those are all important. And, let's just kind of cutting out some of the noise that, can send you into dark places. I think that's super important. And then, like surrounding yourself with folks that, it's a combination, like of folks that are further along in their careers or have seen things different than you, and kind of, really, asking them questions that kind of help them open up in ways that you can learn from them. That's been important to me. And then, investing in coaching too, had a CEO coach for over 2 years now, and, he's been awesome. Just kind of helping me like kind of, cut through the BS that sometimes like I rationalize, on my own, and just kind of, help really like get down to like the core ideas and kind of, avoid making poor decisions.
Sure. Okay. Peter, it's been an absolute pleasure talking to you. I have learnt a ton, and I'm sure kind of everyone that's listening has too. For people that want to find out more, where can they find you, and what kind of, agencies are you looking at?
Yeah. I mean, so, they could look at Barrel Holdings. This is barrel-holdings.com. And, we have our kind of criteria, acquisition criteria there. They could check out as well as look at our agencies in the portfolio. PeterKang.com is where I post, my blog posts. And then LinkedIn, Peter Kang 34 is where I post a lot of content.
Cool. Peter, thank you so much again.
All right. Thanks for having me, Jordan.